All right, we are now recording and looking forward to today's webinar on the legal documents explained for passive investing in apartments, specifically these apartment syndications. We're going to be going into a lot of different details surrounding these documents. We're going to be first going over the documents that are required for investing in passively in these apartments. This will be helpful for you as a passive investor to know what to look for in these different projects, but it will also be helpful for those of you who have not put a deal together before and you're interested and curious about what are all these documents that are needed and required and what are they for. And so to help us explain some of these, we're going to go through and I'm going to show you one of the example PPM documents. It's actually about 110 pages. We're not going to go through all 110 pages because a lot of it's just legal jargon, but we're going to go through the important pieces of it and explain what each one of these different pieces are. The private placement memorandum, the operating agreement, the subscription agreement, the investor qualification questionnaire, and then a question that I get quite often from some of our passive investors is, should I have an attorney review these documents prior to signing them and returning them back? And as most of you guys know, if you've been on with me before, I always add in a few extra little details along the way, that things that just come to my mind that I feel like would be very beneficial for you guys to be able to know and be aware of. So looking forward to today's webinar. If you have questions about it, feel free to use the chat box, or if you're watching the recording, feel free to shoot me over an email or follow me on my Facebook page. Glad to be able to help out and answer any questions that you may have around this or anything else. You can email me directly at dan@passiveinvesting.com. That's dan@passiveinvesting.com. And one other thing that I want to mention is our group. I mentioned a little bit earlier before I pressed the record button, but we have a group. I'm one of the managing partners of a group called passiveinvesting.com. And we acquire large multifamily complexes. So minimum 20 million in acquisition is what we're looking for, primarily focused here in the Carolinas, and also looking for some projects in the Atlanta market and in the Jacksonville, Florida, and Orlando markets, but really heavily in the Carolinas. I'm located here in Columbia, South Carolina. And so if you have questions for me, feel free to reach out. But also, if you're interested in joining us on one of our future projects, on the right-hand side of every page, you will see that there is a place for you to type in your information. And we would love to be able to jump on a phone call with you, discuss your investment goals, and see if you're a good fit for the projects that we're putting together. And then our projects right now are currently open for accredited and non-accredited investors that are also sophisticated. So thank you for allowing me to put that in there. And I have one question coming in from Rob that's asking, are prior webinars available if we have missed it? And the answer to that question is yes. And so I'm going to pull up the YouTube channel here, and I'll type in the link to this inside of the chat box. So if you want to click on this, you can go straight to this page and you will see, sorry about that, I didn't mean to click on that button. You will see that there is the list. There are some Ask Me Any, AMA, Ask Me Anything, things that I've done. Some prior live webinar recordings are in here. Also have our MFI and podcast recordings are in here as well. And then some of our most popular uploads are in here as well. So I would definitely encourage you to go there and subscribe. You see we've already have almost 2,000. So hopefully after today's webinar, we can get over 2,000 subscribers on the YouTube channel. So click on that link inside the chat box. And thank you, Rob, for answering that question. So you can go right over there. And as far as where they're located for these prior webinars, there is a playlist called Prior Live Webinar Recordings. And so the one from last week was the red flags for passive investors. We did one on structuring apartment syndications, finding multifamily investments. You can go there, and we try to do one of these webinars every single week for you so you can continue to learn about these various projects. So, all right, let me get back to where I was going, which is these legal documents. So let's go ahead and start diving into some of this, because I know a lot of you take some time out of your schedule to be with me here today and every single week, and really looking forward to sharing with you each week about some of the things that are in my knowledge base that I can share with you to help you learn more and be more knowledgeable when it comes to investing or putting together these various projects for multifamily investing. So what are the various legal documents that are required for investing passively in apartment syndication? So one thing I want to make clear is that on these apartment syndications, we're not talking about JV partnerships, those joint ventures. So that would be where you wouldn't really need a lot of these documents. It would be like, 3 or 4 people, and you're all going to kind of do various things on the property, and you're going to pool all your money together. That would not necessarily require all these documents. But this is really when you're going to have, 20, 30, 40, 50, investors on a larger project. And, you want to make sure that you're going through an SEC attorney, a securities attorney, to be able to get a lot of this stuff done. So these are going to be some of the documents that SEC attorney would be putting together for you. The securities attorney is what they're called. And the one that I actually use, his name is Dugan Kelly. So you can probably, let me see if I can put this in here. This is actually his information, so you can see that very clearly in here. This is Dugan Kelly. I'll also type that into the chat box here, so if you guys want to follow him, reach out to him if you have any questions for him. Really, really nice gentleman. Great to work with so far, and really benefited quite a bit from knowing him. But when we're putting these various projects together, there's a couple of documents that you need to know about. So the one is going to be the main document, which is the private placement memorandum. Okay, this is going to be where there are a lot of these SEC jargon is being put in there, a lot of different disclosures that need to be put into place. I'm going to show you an example of this, and I just want to go over these various documents first, and then we will actually open up the document and go through it. So the other one is the operating agreement. The operating agreement is the agreement for the actual property, the borrower entity of the property. And in many cases, in most cases, the lender also puts, some things in there, or at least makes some recommendations to put in there. You don't always necessarily have to do all of them. A lot of people think that you do, but they will make recommendations, and you can say, no, I'm not going to put that in there, and they'll still allow it depending on what it is. But there are certain things they want to see in place inside of that operating agreement that you have. Now, if for some reason you don't put it in your operating agreement, they could still potentially put it in the lending document. So you want to make sure that you're still clear on various terms that they might put into place. The next document is the SA, or the subscription agreement. This is basically saying that, yes, I'm an investor and I want to subscribe to a certain number of units. And you'll see how we do the units whenever I open up the document for you to see. But that is the subscription agreement, basically telling the managers of that property or the sponsors, hey, I want to buy this many units for this amount of money. And there's usually a formula in there that are inside of these documents so that it's usually pretty straightforward and pretty clear. And then those are signed off on. The next document is going to be the IQQ, or the Investor Qualification Questionnaire. And this one is going to be in there typically for both a 506B as in Bravo and a 506C as in Charlie. It's really important to have these documents in there, especially on a 506B as in Bravo, because on those 506B offerings, there is no third-party verification of this investor questionnaire that will actually ask the investor if they are accredited or non-accredited. And so obviously with a 506B as in Bravo, you can accept up to 35 non-accredited but sophisticated investors. And then on a 506C, you can only accept accredited investors. We would still have them fill out this investor qualification questionnaire, but then they would also go through a third-party verification to verify that they were an accredited investor. And so let's go ahead and dive right into some of these documents so that you can actually see. So let's see here. I had somebody ask me about making the screen a little bit bigger. Hopefully when I bring it over to this, you can see it okay. Can you guys see this okay? It should be my Word document. So if you can see it okay, just raise your hand or let me know on the chat box. Yes, you can see it. It's good. That way I know that everything is looking okay. All right, good. I got a lot of people raising their hands here. That is good. All right, thank you so much for that. Thank you. I'm gonna go ahead and lower your hands there. And for those of you on here that can't see this, let me know, but hopefully this is big enough so that you can actually see this. So thank you again for paying attention. So this is the private placement memorandum. This is what we call our cover page. It's on every single one of the screens so that you can actually see it. Let me see here. It says, please make window wider. better on the phone. I'm not sure if wider would actually be that much better, but I'll open it up a little bit wider there and maybe make it a little bit bigger. So hopefully you can see that okay. It doesn't really look like a document too much like that, but at least you can kind of see a little bit of it. And don't ask me to send you this document because it is a legal document that I've redacted some information from it, but not all of it. So I can't give this to you, but hopefully moving in and zooming in a little bit will make it a little bit better. So, all right, so you can see here, this is just the cover page. This is the private placement memorandum. If you look down here in the bottom left, you can see this is actually a 110-page document, okay? And so this is a fairly large document, and a lot of the language in here is repetitive, but it's language that needs to be in there in various places for legal purposes. So this is just the beginning stages of it. And you can see that it just kind of goes off and talks about, what the actual offering is going to be doing. So this offering involves the purchase of investment units in MFI and Partners LLC, just a fake LLC that I came up with, which is being formed to purchase the real property known as MFI and Apartments. The property is an existing 300-unit property located in MFI and city in some state. The investment units commenced on whatever date that was, and will continue until all the units are purchased. Now, this is quite important, okay? Because in this particular sentence right here can tell you whether or not you, one, have time to be able to invest in this project, or if you actually have a limited amount of time to be able to raise the money. And so there's a couple of things that we usually do is we usually don't try to put an end date on the amount of money we're raising. Most of the time what we'll do is we'll have like an upper limit and a lower limit in the amount of money that we have to raise in order to be able to acquire the property. So if we don't get the minimum amount, then we can't acquire the property. So far, we've never not hit the maximum limit. We've raised all of the money before we've actually closed a property, but it's great to have that, especially as you grow and scale. And we went actually from a $8.5 million raise to a $14 million raise. We were really confident that we could get to the 14 million, but we wanted to make sure we had that as a backup just in case, because you never know if for some reason you can't raise all that. So this particular one was a $50 million property that we acquired. It was actually $51.5 million that we acquired in Raleigh, North Carolina, which is why the raise amount was $14 million. But one of the things that you'll see in here is you can see that the original amount of units offered is 14 million, and each unit is priced at $1, and a minimum of 50,000 units is required. That means that it's a $50,000 minimum in order to invest in this particular project. Now, I've personally invested in other projects where the unit amount was $1,000 or even $5,000. So you're buying them in increments of units that increase by $1,000 or $5,000. So in this particular situation, if each unit was $1,000 a piece and the minimum investment was $50,000, then you'd be buying 50 units. And so you just have to make sure that you look at that so that you fill these things out properly. And then, of course, it also talks about that each 50,000 units of ownership will be equal to a certain amount of membership interest in the company. Now, our typical projects are a 70-30 split. And so if you do the math here, that actually comes out to that 70-30 split. So I'm going to quickly do the math here on the side. So if we take that 50,000 divided by the 14 million, that's going to get us a 0.36% of the overall 14 million. And you multiply that by the 0.7, and that's going to give you that 20.25% interest in the actual company, so in the borrower entity. Now, this also says additional units may be purchased in blocks of 5,000 units. So there still might be a minimum increase in each one. So we can't do it in 1,000 blocks. It has to be in 5,000 block units. So that's kind of how that particular piece works there. All right. So if there's not any questions, I'm just going to keep on moving on to these various different pieces. So this is basically talking just what we had talked about up here in the written form. It's just written out as well. Per investment, $1, proceeds to the LLC, $1, price to the public. So total minimum, 50,000, total maximum, 14 million. proceeds to the LLC. This is basically stating that all of the 14 million go as proceeds to the LLC. Okay, so the LLC is actually going to be getting each one of these particular pieces. Now, to answer that last question of the list of things we're going to cover with you, inside of our document, it actually tells you before purchasing any of the units offered through this private placement memorandum, consult with an attorney, a financial advisor, or a registered investment advisor to determine if this investment is suitable for you. So it's not a bad idea to reach out to one of these types of advisors or an attorney to have them review these documents. I would say that the majority of our investors do not, basically because they are sophisticated enough and they understand these types of investments already. But if you have questions or you're unsure, it's always best to get that advice from somebody that has more experience with you in it. Just make sure that if it is a financial advisor or a registered investment advisor or an attorney, that they have familiarity with these types of investments, and preferably one that is actually invested in these types of projects as well. I feel like that's a very important piece here to make sure of. So these next few pages I'm going to go through are really just notices to various states. So I'm just going to scroll through these because it takes, a couple of pages actually for this to get through. Stuff that, is required for various, laws in these various states that we're required to disclose. So that was, 13 pages of that. And then of course, you can kind of see how this is laid out, goes over the established standards, methods to assure adherence, talks about, the limited liability company and the manager and the term of the company, and, with the manager receiving these fees and profits and what those are, cash distributions and how those are actually distributed, property to be repurchased. So it goes through a lot of these different pieces, and we're not going to take time today because we don't have time. We don't have time to go through each one of these pieces today. So I'm just kind of giving you a high level overview as to what one of these documents look like. But they're basically just standard disclosures so that you as an investor know how this particular property is going to be run and how the proceeds are going to be used, and how any types of fees or profits that the manager is getting and how those are going to be used. So these are important, and it's good for you to be able to see these as an investor in these various projects. So you can obviously see there's a lot of risk factors, a lot of different things. These things try to scare the pants off of an investor to the point where we can tell them that we warned you up front that it's possible that you can lose all of your money, right? But obviously we all know that the reasons why we like multifamily investing is because of the ability for preservation of capital, as long as you have a good operator on your team, right? A good team underneath you from an operations standpoint. So this is going to talk about federal taxes and everything. So this is all just the PPM up until this point, right? And then you're going to start to get into the operating agreement and things like that. So let's go ahead and just drive down here. I don't really want to go through this entire piece from you can kind of see the calculations and stuff and how things are broken down. You can see here that there's a disclosure here of what are the anticipated closing costs. And you can see there's a little number 1 there, which says that inside of this $2 million, $2,040,000, there is a $1.14 million non-recurring organization or acquisition fee to be received by the managing member, and legal, accounting, printing, and other expenses for this offering. And this would be the acquisition fee. Okay, this is going to be the 2% acquisition fee, and you'll see that in there. And obviously this doesn't all go to just me. Obviously I have 3 managing partners in my group, and then we also have some other co-GPs that helped us with this project that this actually gets split with. So it does seem like it's quite a large number, but obviously this is a $51.5 million project as well. So you can see it talks about the cash down payment or the equity, the working and capital reserves, and then of course the totaling it up and the percentages. So just kind of listing that out. This again kind of goes through and talks about that acquisition fee, the 1.14, loan guarantor fee, profit percentage splits, disposition fee, asset management fee. So all your fees will be disclosed in here as well. And then any types of conflicts of interest. I've had a few questions from investors on these conflicts of interest, because they might say, it says here that you have a conflict because you might have a similar property nearby. And the answer to that is yes, there might be a conflict, and there could be. And where the conflict would be is, taking, tenants or residents from one property and pushing them to another one or vice versa. And to me, instead of it being a conflict, I feel like it's more of a benefit because we have the ability of, economies of scale. And there might be somebody coming to my property, I'll say my property, but property A, right? In that same market that's looking for a 2-bedroom, but my property, or this property A doesn't have any 2 bedrooms available. So I can say, hey, well, have you looked at property B? We also manage and own that one as well. And they can kind of push those people over to that other property. And then same thing when on the other side, property B might not have any 1 bedrooms available or 3 bedrooms, but property A does. And so there's some ability to be able to share some of these, referrals and help the property more than there is a conflict. But there is some conflicts that could arise, and that's what these different areas are talking about. So I'm going to go through the majority of this because it talks about the managers and the management of the company and all of that kind of stuff, and phantom income and the preferred returns, and all the stuff is disclosed in here. And what happens when you sell the property, it has pictures of the property. This is actually a picture of the property that we acquired. So you can kind of see that there. The unit mix, the floor plans that are in here, and all operating details. I mean, everything is in here. And then, of course, now in Exhibit A, we're going to go into the operating agreement. So if you have any questions about the PPM, you can let me know. But a lot of it is just disclosing all the different things that could happen with the property, as well as all the fees and the structure and everything like that. So this right here is not available for me to distribute to you. So I know one of you had just asked that. I think it was Sunny, if they could have a copy of this PPM. It is not available for me to send to you. So I've redacted a few things, but not everything on it. So I don't have one of these as an example to show you. So I do apologize for that. So it's a lot of groups have a hard time releasing this because it is legal jargon, but we can't do that either. So I do apologize for that. But obviously, if you want to, jump in and join one of our projects or look at them, you can certainly do that too. So operating agreement, first off, just going through and actually describing a lot of these different terms, if you will. So these are just the terms: reference rate, reserve, selling member, substitute member, tenant in common. And then it's going to talk about the capitalization. So the time of capital contributions and all these different pieces in here. So this is another thing that I wanted to bring to your attention is this is that important, minimum of raise versus maximum raise. And that still allows you to acquire the property if you don't get the full amount. And so obviously you would still want to continue to raise after you've raised the full amount or the amount that you could close. But here you can see that, the total amount of the initial capital contributions sought from the Class A members who are identified in Exhibit A of this agreement will be $14 million, but will not be less than $10 million. So what that allowed us to do is that even if we got to $10,050,000, we could still close on the property. But if we didn't raise at least $10 million, then we could not close on the property. Thankfully, on this one, it filled up very quickly. So we actually raised that $14 million in just under 2 weeks. So we didn't have any issues there, but we always have that in there as a backup or a fail-safe if we need it. But I always encourage people to look at that and kind of see what's the minimum amount that you need to be able to close. So maybe you're not, you don't necessarily need to have all the CapEx dollars raised up front, or maybe the acquisition fees or some of the other fees that can definitely be done post-closing whenever you're actually raising those funds. So always have that in there as a backup, just in case, so you can at least continue to close the property, especially if you have some, hard money on the line, like we did on this one as well. So we had not like a hard money loan, but money that went hard, the earnest money deposit that was non-refundable when we acquired this property. All right. And one of the other things that we do as a group is we make sure that, as Class B members, as from owning the 30% would be a Class B member, as the GP or the sponsorship team, as that Class B membership owner, we do not pay money to be able to get that 30%. So we do invest alongside of our investors, but this sometimes can get confusing because it says the manager, who will be the sole Class B member, will contribute 0% of the total capitalization of the company. But this is total 0% for their Class B shares. And this is including an initial capitalization and of subsequent capital calls if necessary. Now, we also make sure that this line is in here because we do invest alongside of our investors. So you can see here that the members of the manager are planning to collectively invest at least $1,400,000 in Class A shares along Class A members. I think on this one, we ended up doing a little bit more than that. Just because we ended up wanting to put more in, but because it was a really, really good and really, really solid deal. But right at 1.4 million, that's 10% of the equity required, which was the 1.4 million. So the reason why I bring this up is because we do have some investors that'll ask about that, and they'll say they're going to contribute 0. But we're planning contributing 0 for the Class Bs, but we're still investing alongside you as an investor inside of all of our projects as well. So I feel like that creates a lot of alignment of interest with our investors. All right, so let's go through here. This is the rest of the documents, talks about rights and duties of the manager. And in these types of entities, you as the investor are giving up all of the decision-making power to the managers of the entity. So it's why I harp on it very much, that you want to make sure that whichever operator you're investing in or investing through, they have the ability to do these, to fulfill the business plan that have been put together on these various projects. And so we recently did one on last week on the red flags for passive investors. I would encourage you to go to our YouTube channel and subscribe to it and find that video, because it does talk a lot in detail about vetting various operators and learning and knowing more about what to look for and those red flags before investing with various projects. So this is the operating agreement. I'm going to go through here a little bit. Let's kind of scroll through here. This is basically an operating agreement that you would see in any type of entity and things like that. It also talks through how the investors are going to get paid. So distribution of operating profits, talks about who gets what first. We always have either a 7 or an 8% preferred return. So you can see that it says 7%. Now, one important thing as an investor to look for in these various operating agreements is to make sure that the preferred return, if they are giving you one, which I'm a big proponent of them giving you these preferred returns. I don't personally invest in a project, which I do invest in other people's projects. I'm right now in I am in 18 different syndications as a passive investor through 8 different operators, and I only invest in projects that give a preferred return, and one that is called a cumulative preferred return. There are 2 different types of preferred returns. There's the cumulative, and then there is the non-cumulative. The non-cumulative preferred return would be you only get 7% return year over year on the money that you invested. But if for some reason 1 year they do not hit that preferred return, then you lose it. So you don't get it back. But we actually do in our projects what is called a cumulative preferred return. So if we're projecting to give you a 7% preferred return year 1, and we end up only doing 6%, then the next year you'd actually get 8%. So it actually adds on top of that until you get that return as was originally projected to investors. And of course, you can see in here it talks about how Class A's are given their distributions before Class B's, and then how those are done. I believe 2 weeks ago, we did one on the different structures of multifamily syndications and how they're put together, and explaining a lot of different pieces of it, like the internal rate of return and the waterfalls and equity splits and hurdles and various things like that. But you can see in here, we actually have a 2-hurdle waterfall. So once investors get 100% of the profits up until that 7% return, and then anything from 7% to 16% IRR, they actually would get we do a 70-30 split. And then anything over the 16% IRR, then it gets split 50-50. Yes, that's how this is actually written out inside of these documents. With those that dual hurdle system, it's a 50-50 split. So from that point forward, now that 16% IRR is not arbitrary. It's actually based on our projections. So on this particular project, we projected a 16.2% IRR. So if we hit that 16% IRR, then the profits get split 50-50. And so that's one of those things that that we put into place there to make sure that that the sponsorship team is continually being motivated and incentivized to continue to outperform that property, to be able to hit that secondary hurdle, to be able to achieve the larger returns for the operator as well. So obviously, as an investor, you like that because you like having the incentive of at least getting that 16%, and you'd be happy even if you just got the 16%. But if we can outperform that, then of course that would be that secondary hurdle inside of the waterfall structure. All right, so let's just keep on going through here. Talks about a lot of different things. I want to get to the subscription agreement so you can kind of see that. There's a lot of different things to talk about as far as the subscription agreement is concerned. Let's see here. This is just the legal descriptions, property. All right, so here is the subscription agreement, or this, we call it the subscription booklet. So this is kind of the cover page for it. The investor would put their name, address, and phone number. And then, of course, you can see it's a fairly small document compared to the other two that we were just in. But then we can go down through here. It talks about the minimum investment and the membership ownership and various things like that. And let's see, I have a question coming in from Ted. On sale of property and after Class A has 16% IRR, is the split 70-30 or 50-50? So Ted, the answer is that when we sell the property, once the Class A shares have been given a 16% return, then the profit split changes from 70-30 to a 50-50 split from that point forward. So hopefully that kind of helps explain that a little bit. Not sure if it actually does or not. Let's see here. So this actually talks about, MFI and Partners LLC. You probably saw up here earlier. Those are all of our banking information. So good luck wiring us money. Doesn't have any proper information on here, but you can feel free to send it if you want. But this is all the wiring instructions for you to send in the money for your investment. And then, of course, just basically as in a document, it says subscription agreement. You're going to fill it out. You're going to say, I'm going to tender a check or send a wire in the amount of $50,000, representing the total purchase of 50,000 units. Talks about the minimum investment. Let's see. Total units offered will be 14 million. This really is just a recap of a lot of the things we've already been going over. And then also talks about representations and warranties. And this is kind of getting into a little bit of the IQQ, the Investor Qualification Questionnaire, talking about your net worth. Because in order to be an accredited investor is that you have to have a net worth or a joint net worth with your spouse of at least $1 million, which excludes your primary residence, or you have an individual income of at least $200,000 in each of the 2 most recent years, or you have a joint income with your spouse of at least $300,000 in each of those years, and have a reasonable expectation of reaching the same income level in the current year. So all of those are disclosed there. The other thing has to be an accredited investor, and then of course you're basically stating that you have evaluated the risks of investing in the company, and then you have the knowledge and experience in financial and business matters. Let's see. Yes, it does say and in this particular document. It's not actually accurate. It's not supposed to say and. So good catch there on this particular one. This one, the representations and warranties is not the IQQ. I'll show you that. It should be a little bit more clear when it comes to that. That's a good catch there, Philippe. And because it is either or, it's not. You don't have to have both of those. It's actually or on the income requirements versus the net worth. And let's see, just some additional legal jargon and various things like that. It does talk about that there are substantial restrictions on the transferability of the units. So you can transfer these units from one company that you own to another company that you own. But in order to transfer it to a company that you do not own, or to a different entity or to somebody else, there has to be at least 12 months that has transpired from the time you actually acquired the property to the time you actually were to sell the unit. So it is what is called an illiquid security. So you can't just buy and sell these things as you wish. Otherwise, it kind of falls under other regulations within the SEC. So in order for all these to be able to be under And the exclusions within the Securities Act of 1933, there are certain things that have to be done a certain way, and that's one of them. I believe that's actually Rule 144, if I'm not mistaken. It might be 44, but there's a rule that states that you have to hold on to it for at least 12 months in order to buy or sell your units in here. All right, so this is basically getting more information from you: the purchaser, name, address, city, state, zip, home, business, social security, all this kind of stuff. Co-investor's name, if there is one. You're gonna fill all that information in there. So Philippe is asking, so it is possible to resell a share? So yes, you can. It's all contingent upon the approval of the manager, in that to approve of that sale. But there is the possibility to do that. So that is a possibility, but there has to be at least 12 months that lapse between those between you actually acquired the property and the time you want to sell that share. So you kind of have to think about it that you can't sell it for at least a year into the property. If you have a professional relationship advisor, you can put that in there, the advisor's name, and of course you just sign off on it down here at the bottom. So that's pretty straightforward document, basically just saying, hey, these are the number of shares that I want. And then of course this is our internal use document that we use for receiving the funds and various things like that. I would be here signing this one, and then of course our other manager, Danny Randazzo with PassiveInvesting.com, will be on there as well. And then this is the IQQ, the Investor Qualification Questionnaire. So this one is going to be, we have two different versions. We have one for an individual and we have one as an entity. So I'm going to show you both of those just so you can take a look at them. Information in here is just getting, obviously, name, address, occupation, business address, which states you provide, you maintain your principal residence for the past 2 years. Do you maintain a house or an apartment? And if so, which states? Where do you pay your income taxes, your age? And then here's these qualification questionnaires. Is your net worth in excess of $1 million? Yes, no. What's your individual income? 200 or 300? Yes or no. And then this would be, you could actually, if it's a 506B as in Bravo, say no to each one of these, no, and say yes to, is your knowledge and experience in financial and business matters sufficient to make you capable of evaluating the merits and risks of the prospective investments, and you are a sophisticated investor. So as long as one of these three is checked, you're usually good to go. But obviously in a 506B as in Bravo, we can only accept up to 35 non-accredited investors. So you'd be limited there in that particular piece. All right, and then you would just sign up on the bottom there. Pretty straightforward. This is the entity one, so a little bit more in depth because it has to ask a few more information. As an accredited investor, sophisticated investor inside of an entity, things are a little bit different. So most of the stuff in here, you're not going to be a bank or a savings loan or insurance company, anything like that. One thing that I have being in the process of doing is starting my own 501c3. And so in order to be a 501c3, you have to have an excess of assets and over $5 million. So that would be something you want to make sure that if you have a nonprofit that wants to invest in your projects, that's perfectly fine. They just have to show an assets in excess of $5 million. Would you be surprised at how many 501c3s actually have assets in excess of $5 million? So that is a potential possibility. I'm actually starting a 501c3 right now for a Christian education fund to be able to build up some additional educational scholarships and various things like that. We have to raise at least $5 million in order to get it to that point. But we're going to be working with some other nonprofits to be able to use multifamily as a vehicle to be able to grow their company or their nonprofit. Obviously, you can see here, trust, corporation, or partnership. They also have to have assets in excess of $5 million. And then is an entity in which all of the equity owners are accredited or sophisticated investors under paragraphs 1, 2, 3, 4, 5, 6, 7, 8, or 7 or 8 above, or under one of the following net worth / joint income requirements. So most of the time, an investor is going to select number 9. They're going to be saying yes to one of these. You can see here it does say or, right? But every owner inside of that entity has to meet these qualifications. So that's an important piece, an important distinction as well. All right, and then at the bottom here, you'd basically fill out the rest of this, tax identification number, sign it, date it, and good to go. Okay, so this is the PPM document in a nutshell. It went through 110 pages in about 30 minutes. So I know I went through that very quickly. So if you have any questions, you can feel free to let me know. But let me go back to our other screen here and see if there was anything else that I might have missed that I want to make sure that we cover today with you. So we pretty much covered all of these various pieces in here and answered a lot of your different questions. So if you have any further questions for me, you can obviously always reach me on email, dan@passiveinvesting.com, or one of the easiest ways to do that is to follow me or to find me on my Facebook page. So that Facebook page, let me just pull it up here for you, is just Dan Handford fan. You can actually find me there. So you can actually see the Facebook page. Let me type it into the box here so you can link there. So you can just find that link and type it in there. This is I'm gonna say Dan's Facebook page. And then you can also, if you are curious, you can join us on the Facebook group. So we now have just crested over 5,000 members on the page on our website. I mean, on our Facebook page. So I'm going to type that in here as well. So for those of you who want to join us and continue the conversation there, you can do that as well. So there are a few questions on here. So let me go ahead and take a few minutes to answer some questions that you guys might have come up with. It says, how do you keep investor information private and what measures do you use? So we have a lot of different security measures in place to make sure that the information is kept private. So we use secure ways to be able to share the information between people that need to see the information, but we don't just send the information back and forth, without making sure that that information is protected. So there are certain things, like we actually use a DocuSign for these documents to be signed, and those documents, when they're signed via DocuSign, are fully encrypted to the highest level, and so those are kept confidential as well. And of course, whenever we're doing distributions, that information is housed very privately as well. So it's a good question there about making sure that all that information is as private as possible. Let's see. Can you go over the accredited investor qualification? So there's two things that really fit the criteria, Deborah, for the investor qualifications. Number one, you have to have a net worth of at least $1 million. That does not include your primary residence. Or you have to have $200,000 if you're single, or $300,000 if you're married, of annual income for the last 2 years, and you expect it to continue for the next year. So those are the two things that it's either or. So you don't have to meet both of them, but one of those two you do have to meet in order to qualify as an accredited investor. So good question there, Deborah. Next question is from CE is saying, do most put ownership in their personal name, or do they use other entities? I would say the majority of ours just put it in their own personal name. I would probably say probably closer to 60% of our investors just put it in their own personal name, because they are protected and from other pieces of it of the investment. So the only liability you have from an investor perspective, because you are a limited partner, is the original investment that you invested in. So nobody can come after the property and then get access to you, but there are a lot of people that use entities to be able to invest in these particular projects as well. What term do you typically set for the life of the company? So every state's going to be a little bit different on how they allow you to set term limits on the company. Typically, the company is set for 99 years or something like that, to give us as much long as possible. But once we sell the asset, it's also clear that we have to term the company when we sell the asset as well. So that's a good question there. We don't want to be forced to close the company in 5 years or 7 years, especially if there's a down economy at that period of time. We don't want to be forced to do that just because it's a term company like that. What manager has the authority and right to sell earlier? So you do have the authority as the manager to sell the asset sooner if you wish. You don't have to sell it, even if you're projecting 5 years out. If you as the manager have that authority to be able to sell it sooner or hold on to it longer, but you also have to understand that you are controlling and you have the fiduciary responsibility to your investors to make the best and most advantageous decision for your investors in order to be able to sell that asset and either move it into another one via a 1031 exchange or something like that. So CE is asking another question here about, can other limited partners see a list of all other limited partners? So no, they cannot. So if they wanted to, they probably could force us enough to do that. Most of our limited partners like to have their anonymity in place and intact. And so that hasn't necessarily been an issue as far as that is concerned. But if obviously there is a deal that goes south and they want to push to be able to get a quorum together or something like that to kick out the manager, then obviously there are some contingencies in place for that piece of it as well. So Charlie's asking me, do you have a portal with these docs for investors? No, we do not. We do not have a portal. We've looked at a few of them. I've actually invested myself personally through some other operators that use these portals, and some of them are nice on the front end. Some of them are a little bit more cumbersome, but we have not done that for our group for a variety of different reasons, mainly because we have not had a lot of questions from our investors asking for it. And so I'm a big believer in, if it is not broke, don't fix it. So I would definitely say we have not, but we're not opposed to it in the future if for some reason we need to do that. Any specific concerns for IRA investments? Let's see. Will we have access to review this webinar later? Yes. So this is being recorded, and we will be posting it on the YouTube channel. So you can certainly, subscribe to the YouTube channel and follow us there. I'll type the YouTube channel again inside of the screen here, and then make sure those of you who have not done it yet, you go to the mfinsummit.com and you register for the webinar that's coming up. So that is going to be mfinsummit.com. So make sure you do that as well. Ted is asking, do you pay preferred returns or preferred interest quarterly or monthly, as well as distribution splits? So we do the preferred returns as distributions on a monthly basis. So for example, if you are in a project and you put in $100,000 on a 8% preferred return property, you're going to be getting $8,000 per year, which is roughly around $660 a month. And so you would receive that every single month after we got into the property. And then at the end of each year, we'll look back and see where the additional cash flows are to see if we can make additional distributions on top of that preferred return. But that usually starts on a monthly basis. So for example, this particular project that we looked at the PPM on today closed at the end of October. We'll wait till we have this full month of November under our belt, and we'll make our first distributions in the month of December. So those investors will be receiving those distributions in December. So we do monthly distributions. Let's see here. Any specific current concerns for an IRA investment? How can you decide to extend the lifetime of the project, say to weather a recession? Do you need approval? So no, as Philippe is asking these questions, and the questions are, all these decisions are being made by the manager, and as the investor, those decisions are relinquished to the manager to be able to make those decisions. So if the project is projected for 5 years, but if we get to that 5th year, or hopefully we didn't wait that long, usually we're looking at it 3, 4, and 5 years in and seeing where the market is. If for some reason we're at that 5-year mark and we haven't sold yet, we don't get forced to sell. We can make the decision as a manager outside of the LPs or the investors to hold on to that for a longer period of time if we need to. Now, obviously, as the manager, I want to see from a manager's perspective that they are communicating with the LPs and the investors as to maybe why they had to extend it past the 5-year projection. And as an investor, I think you would understand that, you wouldn't want the manager to be forced to sell something in the middle of a downturn and cause you not to have as good of a return. So a lot of those are done that way. So it looks like we're running out of time here. I know I got a lot more questions from you guys, and I really appreciate all of the a lot of your questions and a lot of your feedback. I can't answer all of your questions today. I really like that you have a lot of interactivity on these, and I'd encourage you to register for some of our future ones that are coming up as well. This is the week of Thanksgiving, so I wish everybody a happy Thanksgiving the rest of this week, and looking forward to being with you guys again next week on our next webinar. And again, thank you guys so much for being here. If you have any further questions, feel free to reach out to me. Glad to be able to help out and continue to answer these questions for you. And for those of you who are haven't done it yet, make sure you go to the mfinsummit.com, register for the webinar, and look forward to seeing you next week on the next webinar.